bips in 2022. It's expected to raise rates by another 200 bips during the remaining months of the year. How far do you think they are going to go today, and what kind of impact is expected in the markets?
I think we're going to see a 75 basis point hike today, but I think the Fed will also potentially set the tone for an even larger hike in September if necessary. I think that the Federal Reserve have been given all kind of a semi-green light to do a larger hike than expected, either today or else in September. Given what we've seen from both the European Central Bank and the Bank of Canada in the past couple of weeks, the Bank of Canada really kind of upped the ante by going straight to a 100 basis point hike. So in a way, that kind of takes some of the sting out of the market. And therefore, I wouldn't be surprised if either the Fed do go down the 100 basis point hike tonight, or maybe they go down the 75 basis point hike tonight, but really kind of prime the market for, you know what, we might actually look to do an even larger hike in September if it's necessary. Why I think the Federal Reserve might not want to rush into a 100 basis point hike tonight is because they spent too long essentially claiming inflation was transitory. Now they seem to be behind the curve. If they were to take a leaf out of the Canadians' playbook, it might give off the impression that they were kind of wrong initially, and now they're going to overcompensate to the far side. It's also worth noting that although inflation PPI continues to be high, the latest flash services PMI report from the US moved sharply into contraction territory. The services sector in the United States accounts for around 70% of total GDP. This could be the kind of early warning sign that the United States is slowing down, or maybe even worse, heading towards a recession. Yeah. And should that be the case, I don't think the Fed will want to be seen to be taking an even more aggressive stance in relation to interest rate hikes at a time when we have very recently seen a decline in their by far most important sector.
David, U.S. Treasury yields have trended lower. There is a clear flight to safety over there. And we can point towards the latest supply cuts in gas supply from Russia to Europe as a reason, also to the growing concerns about a possible American recession that you point out. Some of the evidence was clear in Walmart's profit warning that came out. So if the U.S. economy does slow down significantly, or if commodity prices fall further, do you think there is a possibility that the planned interest rate hikes may not materialize later this year, say in November and December?
I think that the Federal Reserve, for the time being, are going to stay the course in relation to tackling inflation. I don't think they'll be so quick to actually taper off with their interest rate hikes if the economy does cool. Like I was saying a moment ago, central bankers typically like to kind of focus on one item at a time. In my opinion, they can usually give too much attention to that. Up until a few months ago, unemployment was the metric they were gauging themselves by, and they kind of took their eye off the inflation figure. Now inflation running out of control. It's becoming actually very much a political issue. I don't think it'd only be really a case of we actually see a sharp decline in the US economy or even severe negative growth. Well, I think the Federal Reserve would actually look to actually call a halt to the rate hiking cycle, because once again, it's got a lot to do with saying if you're changing your policy, if you're changing your tune by October, November, December, you're essentially admitting the actions you were taking in May, June, July were incorrect. And as even though some central bankers should spend more time eating humble pie and admitting that their more recent actions were wrong, more often than not, they just plow ahead with the incorrect course and then look to reverse it down the line. So I think what's more likely to see is the Fed continuing to hike rates in 2022 and possibly looking at cutting rates in 2023 or into 2024.
So largely you're expecting the Fed to stay the course. Now, what is the impact that's likely on gold in the bullion market? Gold kicked off the second half of the year on a disappointing note. It dropped nearly 6% in July. This was happening even as the US dollar index traded near the 20-year high and inflation continued to rise. So after a major sell-off, gold has been consolidating around the $1,700 an ounce level. Investors fleeing to the US dollar for safety, clearly. Now I want to understand, what's the direction that bullion could take after the Fed policy is announced tonight?
I think gold is going to continue to trade in a relatively small range. On one hand, if the Federal Reserve taking a very aggressive hawkish stance, and we do see the US dollar index get back up towards that 20-year high that it was at not too long ago, that would clearly kind of push that's likely to put a lot of pressure on gold. But at the same time, if we have a sharp rise in interest rates and bond yields, that could lead to a sell-off in stocks. The sell-off in stocks could lead to a flight to quality play. So even though gold would probably fall in the event of a very hawkish Fed, I think any large falls could be cushioned by the flight to quality play. Conversely, if the Federal Reserve are seen to be kind of taking the foot off the gas, as it were, in terms of their hiking cycle, we could see a pullback in the US dollar. A pullback in the US dollar is likely to get a push up gold. But I don't see gold having any major moves in either direction in the near term. That being said, I think when it comes to gold, we're probably more likely to see gold at 1650 than we are at 1800 in the next few weeks.